Okay, let me ask you one thing. Do you remember why you bought Tesla stock 2 years ago? It wasn't because it was just a car company, right? Even back then, smart money was already looking at something else entirely. And right now, the exact same pattern is about to play out with Lucid, and almost nobody has noticed yet. So why does this video matter? Because if you understand exactly why this company is undervalued right now, you can position yourself before the market re-rates it. My name is Moon. I'm genuinely obsessed with tracking how money moves through semiconductors and energy infrastructure. And if you're holding Lucid stock right now and losing sleep over whether to sell, hold, or buy more, hit subscribe, and if this video helps, drop a like too. Alright, here's the thing. Most people look at Lucid and think, weak sales, cash-burning EV startup. That's it. And that's not entirely wrong. It's just only half the picture. Here's what people actually don't know. Lucid already owns world-class 900-volt high-voltage battery technology, but so far the company has kept this technology locked inside a single product, the car. Now, when the CEO recently talked about getting back to basics and returning to Lucid's roots, there was a deeper meaning behind it. Okay, here's where it gets really interesting. Let's talk about Tesla for a second. The reason Tesla is valued at over $1 trillion isn't just because it sells a lot of cars. The real driver is the energy business. Tesla's energy storage business, think Megapack, now makes up about 12% of total revenue. But the truly surprising part isn't the share, it's the speed. Tesla is shipping over 50 gigawatt hours of storage capacity a year, and that segment is growing faster than the car business itself. And this isn't just a Tesla story, it's a macro trend. The global battery storage market is on pace to roughly double in the next 5 years, expanding from about $50.8 billion in 2025 to nearly $106 billion by 2030. That means whoever captures a share of this market isn't just riding one company's growth. They're riding the growth of an entire industry. And here's the part that really matters. This isn't a sell-it-once-and-you're-done business. ESS can keep earning through energy price arbitrage, frequency regulation, and capacity payments. It's called revenue stacking. Think of it this way. Selling one car is like a one-time gig payment. ESS is more like monthly rental income, and that's exactly why the market pays a premium for this kind of recurring structure. Tesla's revenue multiple has climbed to 13.57 times. So here's the question. How is Lucid being valued right now? Right now, Lucid is being treated as an average, and honestly, below average, auto car manufacturer. Its market cap is sitting around $2 billion. Why so low? Weak sales and cash burn risk. The market is basically pricing this like a company fighting to survive. Now, you might be thinking, okay, so what does that have to do with anything? It matters because the gap between Tesla's 13.57 times multiple and Lucid's current multiple, that gap itself is the size of the opportunity. But that gap only matters if there's actually a reason for it to close. And right now, the market is already building that trigger. It's called data center power infrastructure. Okay, this is where it gets really important. Let me show you one chart. As of 2026, 88% of data center power distribution still runs on low-voltage AC. But by 2030, that share is expected to fall sharply, down to around 20%. So what's taking its place? 800-volt DC, high-voltage direct current distribution. Why the shift? AI workloads are exploding, and a single server rack can now need anywhere from a few hundred kilowatts to over a full megawatt. To improve efficiency and cut down on the sheer amount of copper needed, high-voltage DC is basically becoming a necessity. The rollout is evolving too. Right now, it's the sidecar approach, an external power unit bolted right next to the server rack, and it's spreading fast. By 2028 to 2029, this sidecar approach is expected to capture 50 to 60% of the market. The next step is the solid-state transformer, power semiconductors that cut out the middle conversion stage entirely. That rolls out starting in 2027, reaching close to 20% of the market by 2030. So what does this chart really tell us? The entire data center power grid is being rebuilt around high-voltage technology. And this isn't a niche corner of the market either. Hundreds of billions of dollars in AI infrastructure spending are being funneled into exactly this kind of power hardware right now. Every hyperscaler racing to build out AI data centers needs this same high-voltage backbone, which means demand for proven, efficient battery and power technology isn't slowing down anytime soon. All right, let's put every piece of this puzzle back together and apply it to Lucid. When people hear Lucid entering the 900-volt ESS market, there's one crucial detail they miss. This isn't about building brand new technology from scratch. The tech already exists. So all Lucid really has to do is take the battery tech that's already in its cars and repackage it for industrial-scale power storage. And that's exactly why this is a potential game changer. The barrier to entry here isn't technology anymore. It's just a decision. Okay, let's actually run the numbers. Right now, Lucid is trading at roughly a $2 billion market cap, priced like a startup fighting to survive. But let's say the ESS business actually takes off, and Lucid's multiple recovers to just half of Tesla's. Call it 5 to 6 times revenue. What happens then? In that scenario, there's a case for the market cap rising at least 300% from where it stands today. And if Lucid ever fully captured Tesla's valuation framework, the theoretical upside could be a 3 times to 5 times plus multiple expansion from today's level. Let's put the two numbers side by side so it's crystal clear. Today, Lucid trades like a company with roughly a $2 billion valuation. In the scenario we just walked through, even a partial re-rating could put that number several times higher, without a single new car being sold. There's also a survival angle here that's easy to miss. Right now, Lucid's cash flow depends entirely on one cyclical, capital-intensive product: cars. A second revenue stream from ESS wouldn't just add upside, it would reduce the company's dependence on automotive sales cycles for its financial stability. And this isn't just a numbers game, because ESS margins could genuinely help offset losses from the automotive side of the business. So this isn't just about selling more cars, it's about the market changing the entire weight class this company gets valued in. Now, you might be thinking something right now. Okay, isn't this just wishful thinking? Has Lucid even officially announced it's entering the ESS business? Fair point, and I'll be straight with you. As of right now, there is no official announcement that Lucid is entering the ESS business. And the reason I'm covering this isn't to present it as confirmed fact, it's to show you the signal that's forming. The technology already exists, the market is already moving toward 800-volt systems, and the valuation gap already exists. Where those three things overlap, that's exactly where we should be paying attention. And remember, this isn't a bet on hype. The global storage market itself is already growing at nearly 16% a year, backed by real utility contracts and real grid demand. The floor here isn't imagination. It's an industry that's already expanding whether or not Lucid ever enters it. Which means this isn't a story that's already too late. It's actually a story that almost nobody has caught on to yet. All right, let's wrap this up. Lucid already has the technology, the market is already shifting direction, and the valuation gap is already wide open. What's left is just a matter of time. Here's the uncomfortable truth. Most investors only start paying attention to a story like this after the re-rating has already begun, after the multiple has already expanded, and the easy money has already been made. The whole point of watching a channel like this one is to be early to the signal, not late to the headline. Here's your one action step. Watch the next earnings call and check whether ESS or industrial-scale battery applications get mentioned. That's the moment this signal turns real. Money always sends a signal first. Our job is just to read it before everyone else does. Protect and grow what you've built.